Hi there, so in today's video we're going to be talking about diversification. How much diversification should you have in your stock market portfolio? How many shares should you have in your stock market portfolio? We'll be taking wisdom from books. We'll also be looking at what the great man Warren Buffett himself has to say on it, and not just what he has to say but what he actually does. I'll be giving my opinion as well, and I'll be asking your opinions too. If you're new to this channel, welcome. My name's Andy, and on this channel I like to talk about money and success. If you're interested in making, saving or investing more money, please be sure to hit that subscribe button down below, hit the notification bell, and then you'll get notified every time I release a new video. And if you enjoy this kind of content, please do remember to give it a thumbs up, because that helps me tame the YouTube algorithm, which in turn helps the channel and helps me, and I do appreciate that. So let's dive right in. So how many stocks should you have in your portfolio? Well, I want to start by asking you a question. How many stocks do you hold in your portfolio? Please do leave a comment down below and let me know how many stocks you hold in your portfolio. Do you have a target number of stocks for your portfolio? If you've got a target number of stocks, let me know that in the comments down below. I would love to know. Now then, if you've read books like I do, I read lots and lots of books. If you read any of the Rich Dad Poor Dad books, and I have read lots of the Rich Dad Poor Dad books, in fact I have a whole pile of them here, all of these I have read, you will know he calls diversification, our good old friend Robert Kiyosaki, he calls diversification diversification. He does not like diversifying at all. Whereas, if you were to look at books such as The Intelligent Investor, for example, by Benjamin Graham, well, let me give you a quote from that. Here you go, on page 56, in relation to speaking about gold, he says, limit your stake to 2% of your total financial assets, or perhaps 5% if you are over the age of 65. So that's when speaking about gold, that's one of the things. So it does give you limits in this book for different assets, basically. It's an excellent book. Excellent book. I'll put links to all these books in the description down below if you're interested in the books. There we go. I'm going to read you another quote now from this book here, Common Stocks and Uncommon Stock Profits. On the topic of diversification, it says, the horrors of what can happen to those who put all their eggs in one basket are too constantly being expounded. Too few people, however, give sufficient thought to the evils of the other extreme. This is the disadvantage of having eggs in so many baskets, that a lot of eggs do not end up in really attractive baskets, and it is impossible to keep watching all the baskets after the eggs get put into them. I'm going to go into my view first on this a little bit so that you know. How much diversification is right? I think it's down to three things. Your risk profile and how active you want to be, control, how much control you actually have, and what your goals are. So I'm going to give you an example now. I know a man who owns a fish and chip shop. Now, during this whole COVID crisis that's been going on, I spoke to him and I thought it's going to be dire for him. And he actually said to me, business is better than ever. He's making more money than ever before. This is right, our fish and chips. I just had a thought. Fish and chip shops. If you're not from the UK and you're watching this video, fish and chip shops, think of it like the British version of McDonald's, but it tastes a lot better. All right? I'd roll the national anthem about now. No, sorry, folks. Okay. So, fish and chip shops. So what he did, he basically made it so that he did deliveries for people. He had a minimum order. And as a result of that, all the people that just went in and bought a cheap one bag of chips, it eliminated all of those, and he just had higher profit and higher orders values, and it had a delivery charge. So now he makes more money, he tells me, apparently, than he did before. Now the difference being he's got control of that business. Obviously he owns a business, and he's not just investing willy-nilly in the stock market. Now when you're investing in the stock market, you have a much lesser degree of control. So I do think when looking at diversification of anything, even a stock portfolio, you have to be aware that all of your money shouldn't be in just stocks. You should have some allocated in some other asset classes as well, and ideally in things that you control. If it's in something you have a high degree of control over, then I would argue you can put a higher percentage of your wealth in it because you'll have more control of what goes on with it. But let's just get back to stocks and shares for a moment. So when we're talking about risk profile and goals, I personally think they're kind of interlinked. For example, if you're young, you've got lots of time, you might not have lots of money, but you want to grow your wealth fast, then you're going to need to be very focused and not so diversified, and almost put not all your eggs in one basket, but maybe even do that. So lots of eggs in one basket, because you want to focus that wealth as best as you can to grow it as fast as you can. However, if you are older and you're retiring and all you want is a passive income, then actually having that wealth spread over a wide number of baskets, so to speak, or a wide number of shares, does help soften the blow if any one of them goes down. And it does mean you don't need to keep such a close eye on any one, because if any one goes down, it almost doesn't matter as much. If each one, I'm going to exaggerate now, but if each one only made up 1% of your wealth and 1% goes down, you don't really care. Whereas the young person, if they've put lots in to one and that one goes down, they've got time to fix it. But if you were doing that same thing when you were retired, and especially if you were retired with a big pot of money you're risking, you'd be heartbroken as well as bankrupt, obviously, and not have the time to start over again. Now, obviously, if you're a little later in life and don't have the big pot of money, so you're low on time and low on money, you almost have to adopt a similar strategy to that young aggressive investor that we were talking about if stocks and shares is going to be your route. But you might decide that you're better off starting your own business and doing something you have control of to make the money, and then investing that money, maybe using something like the money management system I spoke about in one of my previous videos. I'll put a tag up here, wherever it's going to be. It'll be in one of the corners. So if it's stocks and shares, it's extremely important that you understand what you are investing in. Let's have a little look what Warren Buffett has to say on this very topic. Diversification is protection against ignorance. It makes little sense if you know what you are doing. I'm going to show you one more Warren Buffett quote now. Wide diversification is only required when investors do not understand what they are doing. Now, did you notice a common thing in both of those? It was understand what they are doing. So it's very important when investing in the stock market that you know what you're doing. Before you buy any shares in any company, you should fully research the companies you invest in. You should understand the business. You should only buy when the share price offers good value, and you should understand the financial shape of the business. You should also understand the outlook for the future of the business, because you need to have a good idea of where the business is going to be going. If you don't know, and you don't know that it's financially solid business, you could just be gambling your money. And that's one of the reasons I believe that he's saying you don't want to have too wide an amount of shares, because you won't be able to keep your eye on them all. You need to be able to know which ones are going to go well. But by the same token, you do need some degree of diversification, especially if you're going to be what's known as a passive investor, where you're not really going to keep your eyes on it. In that case, passive investing is exactly what Warren Buffett advocates and tells people they should do. He recommends it, in fact, I believe, for about 99% of the population. He said there should just be passive investors, because if you're not willing to spend the time to research the companies and find out about them, to make sure you fully understand what they do, how they make money, and if they're going to continue to make money into the future, you shouldn't be putting your money in just one or two companies. You should be buying into the market, and the market on a whole, he believes, will rise. And in fairness, over every single 20-year period, as far as history has tracked it, as far as I'm aware, it has always gone up. So the theory so far has proved out correct. So now let's look at one more Warren Buffett quote. Diversification may preserve wealth, but concentration builds wealth. So he's claiming you want to be concentrated, which really, I suppose, agrees with our friend Robert Kiyosaki from Rich Dad Poor Dad, doesn't it? Because he's saying that you should be, not, he calls it diversification, as I said. He's saying you should be focused, basically. So focus on just a handful of things. I believe Mr. Kiyosaki, who I've just knocked over there, our friend Rob, he would say to literally just focus on one thing at a time, which is very good advice. Too many people flit around on things. But I think that's more related to business than just investing. On investing, you do need some kind of a spread. So let's have a little look now at what spread Warren Buffett actually has. How diversified is Warren Buffett? Well, his company, Berkshire Hathaway Holdings, has controlling share in 70 companies. Now notice, controlling share. Remember what I said about having control and being able to make a difference earlier? And my example of my friend with a fish and chip shop, controlling share of 70 companies. This is why this dude's so rich. Notable minority holdings in a further 46 companies, and I'm sure they've got holdings in others as well. I'd say that's quite well diversified. However, look at this, isn't this interesting? At the moment, I looked at the balance sheet. They have 146.5 billion in cash and cash equivalents. That's equivalent to 28%, so nearly 30% of the value of Berkshire Hathaway. So right now, Warren Buffett is clearly ready to pounce. He's got a lot of money in cash, nearly 30% of the entire value of his business. Let's have a look at the breakdown of those now, because I think this really is telling. If you look in the one, the company's way doesn't have a controlling share. It is diversified. This is how it's broken down. But notice the sixth largest holdings make up 72% of the portfolio. So 72% of the portfolio are made up from just 6 shares. And that's how Warren Buffett is doing it. Now, I'd be interested to know, what is the largest percentage of your portfolio you would allow any one stock to be? And do you have a limit on that? Please do leave a comment down below and let me know, because I really would be interested to know if you do have a maximum, because I think there's not a right or wrong answer on this, to be honest with you. Me personally, the vast majority of my wealth is tied up in property. I have quite a large amount in cash as well at the moment, and I also have a stocks and shares portfolio as well as business interests. So I have various different asset allocations, and then within my shares portfolio I then break it down further. I do feel with shares that I invest in, I don't have control, and that's why I like to spread them down. And really, I would like 5% per holding is kind of my limit on most holdings. So I'm really looking around that level. To be honest with you, at the moment, I must be over that level because I only have 14 shares that I've invested in. But that's because there's only 14 shares that I've found that I've been comfortable to invest in at this present point in time. As I find more that I think, yeah, they're good ones, I'll be adding those to my portfolios and growing them portfolios. But I'm thinking I'm probably going to go somewhere around the 20 shares mark. It'll give me enough that I can keep an eye on it. I might go a little bit more. Time's going to tell. I'm actually intrigued, and that's part of the reason, if I'm honest with you, for making this video, because I want to really know, what is everyone else doing? What are your opinions? If you let me know in these comments down below, I really would be grateful, because it is an interesting thing. I've seen some YouTubers and they say, oh, I'm just going to have 5. Well, but those guys, they just do shares and nothing else. I have other business interests that I control where I make money, as well as property. Again, I have a good degree of control on to make money. So the shares side of things, I'm growing that as more of a passive thing long term. And eventually my goal with that will be to be able to retire on shares, which would be nice. So I'm looking to grow my dividend income. But of course, I'm mixing that with a little bit of growth as well. So I would be interested to hear what your strategies are in the comments down below. Thank you so much for watching. I hope you've enjoyed this and found it helpful. All that leaves me to say is thanks for watching, and bye-bye.